Hey everyone, Alex Morgan here. And Standard Chartered just said the words that every Bitcoin holder in America is dreading right now: $50,000. Let that sink in. The same bank that had a target of $150,000 on Bitcoin just months ago is now warning that BTC could be cut in half from where it already is. So the question I am going to answer in this video is dead simple. Should you panic? And by the end of this video, you will have a clear, data-backed answer. No hype, no fear-mongering, just the numbers, the context, and exactly what to do with this information. Stay with me. Let's set the scene first, because if you have not been following crypto closely this month, the setup here is genuinely jaw-dropping. Bitcoin hit an all-time high of $126,272 on October 6, 2025. That was the peak, the mountaintop, the moment where every crypto bull on the internet was posting Lambos and moon emojis. Fast forward to today, February 28, 2026, and Bitcoin is trading at approximately $67,900. That is a decline of 46.36% from the all-time high. Nearly half of Bitcoin's value has been erased in less than 5 months. The total crypto market cap has dropped from its peak to $2.26 trillion, down from well above $3 trillion at the height of the cycle. Bitcoin's year-to-date performance for 2026 alone is negative 23.9%. February has been the single worst month in recent memory, with Bitcoin falling as low as $61,000 earlier this month, before a brief recovery attempt brought it back above $67,000. That recovery, by the way, was fueled largely by a $323 million short squeeze and $257.7 million in ETF inflows on February 26th. A one-day sugar rush that the market is already beginning to digest. And it is right into this environment, this bruised, battered, uncertain market, that Standard Chartered dropped its bombshell warning. Standard Chartered now projects that Bitcoin could fall to around $50,000 before stabilizing and eventually recovering later in 2026, representing a dramatic downgrade from its prior forecasts near $150,000. This is the second major revision the bank has made in less than 3 months, reflecting persistent volatility, waning ETF inflows, and an uneven macroeconomic backdrop. To put that in plain English, one of the most respected global financial institutions, one that was among the loudest institutional Bitcoin bulls during the 2025 rally, has now flipped to warning retail investors that the pain may not be over. That is not something you can dismiss as noise. But here is the critical question, and this is where most YouTube videos get it completely wrong. Is Standard Chartered's warning based on fundamentals, or is it based on fear? Because there is a massive difference between a data-driven price target and a bank reacting emotionally to a downtrend. So let us go layer by layer through the actual reasons behind this warning and figure out which one it is. The first and biggest reason is what analysts are calling the Great ETF Flush. When Bitcoin ETFs were approved in the United States in early 2024, it was treated as the holy grail of institutional adoption. Billions of dollars flooded in. BlackRock, Fidelity, Invesco, the biggest names on Wall Street were suddenly in the Bitcoin business. And for a while, it worked exactly as advertised. But what nobody was fully accounting for was the fact that US markets had become dominated by hedge funds running basis trades, a strategy where you buy the spot Bitcoin ETF and simultaneously short Bitcoin futures to capture the spread between the two prices. It is essentially a market-neutral arbitrage play that has nothing to do with long-term belief in Bitcoin. When funding conditions tightened in early 2026 and volatility spiked, these hedge funds began unwinding their positions rapidly. The result was a flood of ETF selling that had nothing to do with Bitcoin's fundamentals and everything to do with leveraged arbitrage trades blowing up simultaneously. Holdings of Bitcoin ETFs have declined by nearly 100,000 BTC from their October 2025 peak, and year-to-date ETF net outflows in 2026 have already hit $2.6 billion. That is not retail panic selling. That is institutional deleveraging, and it is a completely different animal. The second driver is macro, and I cannot stress this enough for a US audience. Bitcoin in 2026 is not trading like a decentralized, inflation-hedging digital gold. It is trading like a high beta risk asset, which means when the stock market sneezes, Bitcoin gets pneumonia. Christopher Hamilton, head of client investment solutions for APAC at Invesco, put it perfectly. The move lower in Bitcoin looks less like a crypto-specific shock and more like a classic risk sentiment reset. He described the plunge as likely a reflection of tactical de-risking rather than a structural exit from crypto. The macro backdrop in February 2026 is genuinely hostile for risk assets. U.S. tariff policy remains unpredictable under the Trump administration. Geopolitical tensions, particularly around Iran, are elevated. The Federal Reserve has not yet committed to rate cuts in 2026, and every time a hawkish signal comes out of the Fed, Bitcoin sells off. Add in the fact that Coinbase, the largest U.S. crypto exchange, just reported a $667 million net loss in Q4 2025, with revenue down over 20% to $1.8 billion. And you have a picture of an industry that is feeling the full weight of this macro environment. The third driver, and this one is uniquely American, is tax season. The IRS introduced the new Form 1099-DA for the 2026 tax season, which adds a layer of compliance complexity that some US-based crypto investors may not have been prepared for. Analysts have flagged this as a potential catalyst for forced selling, as investors liquidate positions to cover tax liabilities from their 2025 gains. Think about it. If you bought Bitcoin at $30,000 in 2024 and rode it to $126,000 by October 2025, you have a massive taxable gain. Even if you did not sell at the top, you may need to sell now to pay Uncle Sam. This kind of forced selling is quiet, consistent, and almost impossible to see in the charts in real time, but it adds meaningful downward pressure every February and March. Now let us look at the technical picture, because the charts are telling a story that every Bitcoin investor in the US needs to understand right now. Bitcoin is currently testing the 50% Fibonacci retracement level at approximately $67,683. The next important support levels are at $67,409 and $66,523, while the key resistance sits at $68,300. The market structure is neutral, tilting toward mildly bearish due to macro sentiment and decreasing trader leverage. On the 4-hour chart, the MACD has recently flipped bullish, which sounds encouraging, but the histogram is already starting to fade, meaning momentum is not accelerating. Bitcoin is trading below both its 100-day and 200-day exponential moving averages. The 200 EMA sits at approximately $72,604, meaning Bitcoin would need to rally roughly 7% from here just to get back to what technicians consider the line between bull and bear market. And perhaps most significantly, the 14-day RSI is sitting at approximately 23. That is a deeply oversold reading, the kind of level that historically has preceded sharp bounces. The last 3 times Bitcoin's RSI was this low were in the depths of the 2022 bear market, the March 2020 COVID crash, and the mid-2021 correction. In every single one of those cases, Bitcoin eventually recovered significantly. But, and this is critical, in some of those cases, oversold got even more oversold before the bounce arrived. An RSI of 23 tells you the selling has been extreme. It does not tell you the selling is finished. So now, should you panic? Here is the honest, data-driven answer, broken into 3 scenarios that every US investor watching this needs to understand. In the bullish scenario, which I assign roughly a 30% probability right now, Bitcoin holds the $67,400 support level, ETF inflows return in a meaningful way, and the Federal Reserve signals a rate cut path for mid-2026. Under this scenario, Bitcoin could rise towards $68,300 to $69,000 in the short term, and potentially reach $80,500 by end of March if investor sentiment improves and higher highs form on the bigger time frame. Longer term, this sets up a path back toward $100,000 by year-end, which is still Standard Chartered's base case recovery target, even in their downgraded forecast. Grayscale, Bitwise, and Tom Lee at Fundstrat are all still projecting new all-time highs in 2026, under the assumption that the macro environment improves in the second half of the year. In the base case scenario, which I give about a 45% probability, Bitcoin consolidates in a range between $64,000 and $75,000 for the next several weeks. The market finds a bottom, ETF outflows stabilize but do not reverse strongly, and Bitcoin grinds sideways while waiting for a macro catalyst. This is exactly the scenario that most prediction markets and analysts are currently pricing in, a trading range as the market searches for a definitive bottom, with less than 10% odds assigned to Bitcoin reclaiming $100,000 before the end of February. In this scenario, patience is the strategy. The downside is limited, the upside is slow to materialize, and the market is essentially in a holding pattern waiting for the Fed, for ETF flows, and for macro clarity. In the bearish scenario, which I give a 25% probability, Bitcoin breaks below $65,000, fails to hold $63,000, and the Standard Chartered warning becomes reality. Analysts have flagged that a sustained breach below $60,000 to $58,000 may trigger deeper losses toward the high 40,000s, with a worst-case flush potentially revisiting the $50,000 level that Standard Chartered has warned about. Standard Chartered explicitly warns that Bitcoin could fall to around $50,000 in the coming months if ETF outflows continue and macro conditions deteriorate further. Under this scenario, a combination of forced tax selling, continued ETF outflows, a Fed that stays hawkish longer than expected, and an escalation in geopolitical tensions sends Bitcoin to a level that would represent a 60% drawdown from the all-time high. Painful, but also, historically speaking, not unprecedented. Here is what makes this moment genuinely interesting, though, and why I think panic is the wrong response even in the bearish scenario. Standard Chartered noted that on-chain data paints a comparatively resilient picture. Core network usage indicators are actually showing improvement, suggesting Bitcoin is continuing to attract transacting users even as speculative interest is cooled. The network itself is healthy. Transactions are being processed. Long-term holders, the wallets that have held Bitcoin for over a year without moving, are not selling at scale. This is the signature of a market that is going through a speculative detox, not a fundamental collapse. The tourists who bought Bitcoin at $100,000 on FOMO are leaving. The conviction holders are staying. That is actually how sustainable bottoms are built. And there are positive macro catalysts on the horizon that could shift this picture quickly. Indiana just passed House Bill 1042, which limits taxes on Bitcoin payments and requires state retirement plans to include crypto investment options, a significant piece of state-level adoption legislation. More states are watching. If the Federal Reserve pivots even slightly dovish at its March meeting, risk assets, including Bitcoin, could rally sharply. And if ETF inflows reverse, even partially, the technical picture flips from bearish to bullish almost overnight. The long-term picture also deserves a mention because it provides essential context. ARK Invest's Cathie Wood still has a $1 million Bitcoin price target by 2030. Standard Chartered, the same bank warning of $50,000 in the near term, has a $500,000 long-term target for Bitcoin. JP Morgan sees $170,000 in the medium term. These are not fringe predictions anymore. They come from some of the most sophisticated financial institutions on the planet. The question is never whether Bitcoin recovers long-term for these analysts. It is how much short-term pain comes before that recovery. So here is the bottom line, Alex Morgan style, straight and clean. Bitcoin at $67,900 with an RSI of 23, sitting 46% below its all-time high, facing ETF outflows, macro headwinds, and a Standard Chartered warning about $50,000. That is a genuinely difficult environment. The warning is real, the risks are real, but panic is still the wrong answer. Because panic means selling at or near the bottom of a cycle that every major institution on Wall Street still believes ends significantly higher. The data says watch $65,000 like a hawk. If it holds, the setup for recovery is building. If it breaks, the $50,000 scenario becomes very real and very fast. What you should not do is make an emotional decision in either direction based on one bank's revised forecast. Standard Chartered was wrong at $150,000. They may be wrong at $50,000. The only thing that is not wrong is understanding the data, knowing your risk tolerance, and positioning yourself accordingly. I am Alex Morgan. If this breakdown gave you clarity, drop a like, subscribe, and tell me in the comments, what is your Bitcoin price target for the end of 2026? I read every single one. See you in the next one.